Hello, my fellow gold and silver investors. Welcome back to Gold Rush Reporter, the channel where we analyze precious metals with logic, data, and context, not hype and fantasy. If you are here looking for clickbait price calls, this is not the place. If you want to understand why serious institutions are saying what they are saying, then you're exactly where you should be. Now let me start with something that genuinely deserves attention. Despite offering no official price forecast, a major US bank has openly entertained the idea of $309 silver. That alone is extraordinary. Not because it guarantees anything, but because institutions of this size and influence are extremely careful about what they put into public analysis. They do not float numbers like this casually. So in this video, we are going to do what most people won't. We're going to slow this down, strip away the exaggeration, and examine the reasoning behind it. It is normal for precious metals strategists at large banks to publish outlooks on gold and silver. That is standard practice. What is not standard is the analytical framework being used here. And that's where things get interesting. I'll be upfront with you. I do not fully agree with this analysis, but dismissing it outright would be lazy. Some of the logic actually holds water, and that's what gives this discussion credibility as a long-term framework, not a short-term prediction. According to an article by Juhi Mirza, citing Kitco News, Bank of America has laid out a revised metals timeline looking toward 2026 and beyond. Their baseline assumption is straightforward. Gold continues to function as a hedge. On that point, there's very little controversy. Gold does not need bold forecasts to justify its role in a world of rising debt, geopolitical tension, and monetary experimentation. Silver, however, is where the analysis departs from the usual script. Bank of America strategist Michael Widmer suggests that silver could eventually trade in a range between $135 and $309 per ounce over the long term. Those are not rounded numbers. They are precise, and precision usually signals a model-driven approach rather than speculation. Widmer's argument is that as investors continue reallocating capital into perceived safe havens, gold and silver among them, silver may continue to outperform due to its smaller market size and dual role as both a monetary and industrial metal. Now let's pause here and inject some honesty. Silver has already outperformed gold over the past year. That is not an opinion, it's a fact. Gold has done well, but silver has delivered stronger percentage gains. That does not mean silver is guaranteed to keep winning. In fact, capital has a habit of rotating back toward gold when risk appetite changes. And that matters, because investors are fickle. We've seen capital rush into high-risk assets like Bitcoin and other digital currencies, and we've also seen capital rotate out of them and back into precious metals. These flows are not ideological, they're opportunistic. And silver, because of its volatility, amplifies those moves in both directions. At the same time, silver is not alone. Industrial metals across the board are rising. Copper, in particular, has surged to near all-time highs, approaching $6 per pound. That is not speculation. That is supply chain stress and global realignment showing up in price. This is the broader context Bank of America is operating in. Not just precious metals, but a world where resources are being repriced, supply chains are fragmenting, and geopolitical leverage is being exercised through materials. So when you hear 309-odd silver, don't hear a prediction. Hear a stress test of the system. All right, let's dig deeper into the reasoning behind the $135–$309 silver range. The foundation of this analysis lies in the gold to silver ratio, a concept that every serious silver investor needs to understand. This ratio is simply the number of ounces of silver it takes to buy 1 ounce of gold. Right now, it sits around 59 to 1. Historically, this ratio has swung dramatically. Analysts use it as a tool to gauge silver's potential upside relative to gold. That's exactly what Bank of America did. But there's nuance here that most coverage misses. Let's start with the lower end of the forecast, around 135. In 2011, during the last big metals bull market, the gold to silver ratio briefly hit 32 to 1. At the time, gold was much cheaper, but silver still soared to nearly $50 an ounce. If you apply that same ratio to today's gold price, it produces a silver price of about $135 per ounce. That is where the lower bound comes from, and it is grounded in historical precedent. It's realistic, achievable, and supported by both industrial demand and investment patterns. Now, the upper bound, $309, is where things get extreme. This figure comes from the 1980 ratio low, roughly 14 to 1, when silver prices skyrocketed during a perfect storm of inflation panic, speculative mania, and the Hunt brothers' attempt to corner the market. If today's gold price were combined with that ratio, silver would mathematically land at $309 per ounce. Here's the critical distinction. The $309 figure is not a base case forecast. It is a stress scenario designed to test the boundaries of what could happen under extreme circumstances. It assumes massive speculative pressure, extraordinary capital rotation, and extreme investor behavior, none of which are guaranteed. Expecting it to happen without those conditions is unrealistic. So where does silver actually stand today? On one hand, we are in a persistent structural deficit. Demand has exceeded supply for 6 consecutive years. Industrial applications, from solar panels to electronics to defense, continue to grow. Investment demand remains strong, especially when investors rotate away from riskier assets like cryptocurrencies. That's a solid foundation for upward pressure on silver. On the other hand, market structure today is far more complex than in 1980. Derivatives, futures contracts, ETFs, and regulation all make it harder for a few players to dominate the market. Substitution effects in industry can reduce demand if silver becomes too expensive. Investor behavior is also more rational on average. Many institutions favor gold over silver for stability. These factors limit the potential for extreme price swings. Widmer argues that silver appeals to investors willing to accept higher risk for higher potential reward. This is true. Silver's smaller market size compared to gold makes it more responsive to capital flows. But volatility cuts both ways. Any sudden reversal could wipe out gains just as quickly as it creates them. The takeaway is clear. $135 is plausible, $309 is extreme, and anything beyond that requires conditions that are currently unlikely. Silver's upside is real, but it's bounded by structural, industrial, and behavioral limits. Looking forward, what matters most is understanding the difference between reasonable upside and stress test scenarios. Reasonable upside is grounded in current deficits, industrial demand, and mild compression in the gold to silver ratio. Stress test scenarios, like $309, exist to remind investors of what could happen if multiple extreme conditions align simultaneously. Now that we've covered the gold to silver ratio and how it underpins Bank of America's $135–$309 silver range, it's time to zoom out and look at the broader market forces affecting silver. This is crucial because silver doesn't operate in isolation. It is part of a global network of resources, industrial demand, and geopolitical influence. If you ignore these factors, you are not analyzing. You're guessing. Let's start with copper. Copper has recently surged, approaching $6 per pound, near all-time highs. Unlike silver, copper is primarily an industrial metal. Its price reflects electrification, renewable energy projects, and infrastructure spending. When copper spikes, it signals global resource tightness. That tightness affects silver indirectly, because investors view metals as part of a broader resource basket. When industrial metals are hot, precious metals benefit from capital rotation and speculative interest. Now, the key player in all of this is China. China imports roughly 60% of the world's copper ore, produces over 45% of refined copper, and consumes nearly 58% of refined copper. This gives China not just supply control, but also pricing influence globally. Silver is affected because, like copper, it is a strategic metal with both industrial and monetary uses. Supply chain disruptions anywhere have ripple effects everywhere. Next, consider lithium, another critical metal. Lithium prices plunged nearly 90% in mid-2025, but have since doubled. Why? China dominates lithium chemical processing, controlling 60-70% of the market. Their influence extends downstream into battery manufacturing, giving them leverage over global supply chains. This kind of dominance shows why strategic metals, silver included, can react sharply when geopolitical or trade pressures arise. Speaking of strategic metals, let's bring in molybdenum. This is a metal most people never think about, but it is essential for steel, pipelines, aerospace, energy infrastructure, and defense systems. China controls about 42-45% of global molybdenum production, and in 2025 introduced strict export restrictions citing national security. Exports to the West collapsed 95% in a single year. This shows how a single country can dramatically influence availability and pricing. Silver may not be as tightly controlled, but the precedent matters. Scarcity and geopolitics can create volatility in any critical metal market. Then there's uranium. With energy independence and national security priority, the US is trying to secure domestic or friendly source uranium. Tech giants like Amazon, Google, and Microsoft are bypassing traditional utilities and directly sourcing nuclear power, which requires uranium. Uranium supply constraints, similar to silver deficits, can affect investor behavior and capital allocation, pushing funds toward other strategic metals. What does all of this tell us about silver? Capital rotation matters. Investors move money across commodities, not just silver alone. When multiple metals are constrained or rising, silver often benefits as part of that rotation. Supply constraints amplify moves. Silver has been in deficit for 6 consecutive years. Combine that with industrial demand and global scarcity, and price sensitivity increases. Geopolitics matters. Export restrictions, trade disputes, and national security priorities create a tighter market. China's control over lithium, copper, and molybdenum illustrates how dominant players can influence entire markets. Now, here's the reality check. Silver's upside potential is significant, but it is bounded. Extreme forecasts like $309 require conditions that are extraordinary: massive capital influx, sustained deficits, and market panic. That doesn't make the scenario impossible, but it is far from probable. More realistic outcomes fall between 100 to 135s, based on persistent supply deficits, mild ratio compression, and capital rotation. Understanding these global dynamics is critical. Silver's price is not just a function of investor sentiment, it is also a reflection of industrial demand, supply chain dominance, and geopolitical leverage. This explains why analysts like Widmer are raising eyebrows with high-end projections. They are stress testing what could happen if multiple extreme factors align. Now it's time to get realistic about $309 silver. Most people either dismiss it as absurd or take it at face value. Both are mistakes. To properly analyze silver's potential, we need to ask, what would actually have to happen for silver to reach this level, and what factors would prevent it? First, let's look at the conditions required for extreme upside. Silver reaching $309 would require a perfect storm of events. this is not a normal bull market scenario. It would need a combination of financial instability, concentrated buying, and persistent deficits. The first element is financial panic or a collapse of confidence in traditional assets. Not just a minor correction in stocks or bonds, but a broad, systemic re-evaluation of paper wealth. In that environment, gold tends to benefit first, followed by silver, which is smaller, more volatile, and more sensitive to sudden capital inflows. This kind of panic creates a flight to physical assets that can dramatically compress the gold to silver ratio. Second, there would need to be concentrated accumulation by extremely wealthy investors or sovereign funds. Silver's market is small compared to gold, meaning a handful of large buyers can have an outsized effect. If 10 or so billionaire-level investors aggressively acquired silver, the market could tighten rapidly. This is historically plausible. We've seen concentrated buying dramatically move metals markets in the past, though conditions and participants are different today. The third factor is a continuing structural deficit. Silver demand has exceeded supply for 6 years in a row. If these deficits continue, and inventories fall to levels where delivery risk becomes visible, confidence in paper pricing could weaken. That is when ratios can swing violently, not gradually. Now, let's be honest about what works against $309 silver. Market structure today is far more complex than in 1980. Futures markets are deeper, ETFs dominate investment flows, and regulations limit extreme positions. It is significantly harder to corner the silver market without triggering intervention. Any attempt to replicate 1980-style price moves would face structural obstacles. Industrial demand also provides a natural check. Silver has many industrial applications: electronics, solar panels, medical equipment. But these industries can adjust if prices spike excessively. Substitution, efficiency improvements, or temporary production adjustments can dampen extreme price movements. Investor behavior is another limiting factor. Gold is widely recognized as a hedge. Silver is still somewhat speculative. Institutions often prefer gold when risk rises. That limits silver inflows unless extreme panic or hype occurs. Here's the key takeaway. 309 is a stress scenario, not a base case forecast. It's a theoretical ceiling, showing what could happen under extraordinary circumstances. It's a tool for understanding risk asymmetry, not a guaranteed outcome. That said, stress scenarios are useful. They define boundaries and help investors plan for tail events. Silver does not need to hit $309 to reward investors. Even a move to $100 or $135, which aligns with persistent deficits, capital rotation, and a modest compression of the gold-to-silver ratio, represents meaningful upside. Silver's real power lies in asymmetric potential. It is volatile, but small inflows and strategic capital shifts can produce outsized returns. Extreme outcomes are unlikely, but moderate ones are probable if current trends continue. Deficits, rising industrial demand, and selective capital rotation into metals. The smart approach is not to anchor on headlines. It is to understand why silver behaves the way it does: structural deficits, industrial demand, and capital sensitivity. By doing that, you can identify opportunities without falling for hype. Now let's bring all of this together and draw clear, actionable conclusions. Bank of America's $309 silver scenario has grabbed headlines, but the real story is in the framework, not the number itself. Understanding that framework is critical for anyone serious about investing in silver. First, let's be clear. 309 is not a forecast. It is a stress test scenario designed to explore what could happen under extreme conditions. Those conditions include concentrated accumulation by wealthy investors, persistent deficits, and a flight to safety triggered by financial or geopolitical shocks. It's a boundary, not a base case. The more realistic takeaway is that silver has significant upside potential even without hitting the extreme upper bound. Persistent supply deficits, rising industrial demand, and capital rotation into metals suggest silver could see meaningful gains over the next few years. Based on these factors, prices in the $100 to $135 range are plausible without assuming extreme scenarios. That's where historical ratios, like those seen in 2011, become highly relevant. Gold to silver ratio analysis remains the most effective tool for understanding potential. Currently, the ratio sits around 59.1, far above historical lows. Compression of this ratio, driven by silver inflows and gold stability, can push silver prices significantly higher, even without a perfect storm. The lesson here is simple. Silver's gains will likely come in phases, with volatility and pullbacks along the way. Next, let's consider the global supply context. China dominates multiple critical metals, including lithium, copper, molybdenum, and even strategic minerals. They control not only production, but also downstream processing and export policy. Geopolitical tensions, trade restrictions, and national security considerations can create supply shocks that indirectly benefit silver. Uranium, lithium, and copper markets show that scarcity and leverage matter, and silver is increasingly affected by these dynamics. Industrial demand is another structural factor. Solar panels, electronics, defense, and emerging energy technologies require silver. Unlike gold, which is primarily an investment hedge, silver is both industrial and monetary. This dual role amplifies price movements when global conditions shift, giving it higher upside potential compared to gold. However, we must temper optimism with reality. Market structure today is more complex than in 1980. ETFs, futures, and regulatory oversight make it harder for small groups of investors to dominate the market. Industrial substitution can moderate extreme price spikes, and investor behavior tends to favor gold during periods of high uncertainty. Silver's market is volatile, but it is also bounded. So here's the honest takeaway. $135 silver is achievable under realistic conditions. $309 silver is an extreme stress scenario, highly unlikely but mathematically possible if multiple rare factors align. Silver's short to mid-term gains depend on supply deficits, industrial demand, and selective capital rotation. For investors, the smartest approach is to think in frameworks, not headlines. Understand why silver behaves the way it does, monitor global supply pressures, and watch for structural shifts in investor behavior. This gives you the ability to position yourself for asymmetric upside without relying on speculation or hype. Finally, Bank of America's analysis is valuable because it forces us to consider scenarios that most analysts ignore. It challenges assumptions, highlights risk asymmetry, and frames silver as a strategic asset rather than a mere speculative commodity. Treat the numbers as guidance, not prophecy. So, my fellow investors, think critically, stay informed, and focus on long-term fundamentals. Silver's journey is volatile, but for those who understand the market, it is full of opportunity. If you found this breakdown helpful, make sure to like, comment, share, and subscribe to Gold Rush Reporter. I read every comment, and your insights help shape future analysis. Stay rational, stay strategic, and always respect the market's realities. Silver's story is far from over, and understanding it properly is your edge.